Welcome back. The topic for the day is now, whenever we do a business, we face a lot of uncertainties. We may not be able to say accurately whether our new venture will be a success or a failure, or we may not be able to accurately predict the demand of our product in the coming years. But if we could get information about the future beforehand, then we could make arrangements accordingly. Like before starting the new venture, if we already know that the business will be a failure, then we can just not start it. So there is a value that is attached to the information. Now, this agent 008 is an expert in market analysis. He will analyze the market and he will review your business or your product, and he will give the perfect information as to whether you will succeed or whether you will fail in the future. And he will not work for free. We will have to pay him dollars. So what is the maximum amount that we can afford to give to this agent 008? That is known as value of information. And how do we calculate it? Let's get to the details. Your company plans to develop a new product. The research and development cost expected is $40,000. Probability that the product launch will be successful is 70%, which means that 30% there is a chance of failure. Expected profits for successful launch. If the product's popularity is high, then the expected profits is $100,000 and the probability of the occurrence is just 20%. And if the product's popularity is low, then the expected profit is $60,000 with a probability of 80%. If the product launch is a failure, then we have got an option to sell the R&D work for $5,000. But the probability that we can sell it for $5,000 is just 60%. And the probability that the research and development work is worthless is the balance. That is 100 minus 60 or 40%. Now, Agent 008 can give perfect information for success or failure. What is the value of the information? Now, value of information is given by the formula the expected value with perfect information minus expected value without the information. What does this mean? Expected value is nothing but the average profits. So what is the average profits that we get after getting this information minus the average profits that we get without getting this information? So basically, we are trying to find out what is the additional profit that we will get if we get this information. So that is a maximum amount that we can pay to agent 008. So first we will tackle this part, that is expected value without the information. So we will draw a decision tree. So in a decision tree, what is the first thing? It's a square. That is a decision point. So what is the decision that we have to take? Whether we should develop a new product or we should not develop the new product. So now in this particular case, R&D expenditure expected is $40,000. So that is why it's written negative $40,000 as an expense which is to be incurred if we follow this path. Now, if we do not develop this product, then what is the profit that we earn? We earn a profit of 0. So that is why 0 is written against the do not develop option. If we decide to develop the new product, there is a probability. So it is indicated by the circle, that is a chance point. What is a chance? There is a chance that the product launch will be successful with a probability of 70%. So we write here success and the probability is 70%. So failure is 100 minus 70 or 30%. So failure, it is 30% probability. Now expected profits for a successful launch, that is this path, okay? If the product's popularity is high, then the expected total profit is $100,000 and the probability is 20%. And if the popularity is low, the expected total profits is $60,000 with a probability of 80%. So let's include that too in the decision tree. So if we are successful, there is a chance. So again, it's a circle. What is a chance? There is a chance that the product's popularity is high with a probability of 0.2. That's coming from here. with an expected total profit of $100,000. So that's coming from here. And there is also a chance that the product's popularity is low with a probability of 80%, that's coming from here, with an expected total profits of $60,000. That's coming from here. If the product launch is a failure, so now we are going to adopt this path. Okay. Probability that the R&D work can be sold for $5,000 is 60%. So again, there is a chance. What is a chance? There is a chance that we can sell the R&D work for an amount of $5,000 with a probability of 60%. 60% coming from here and $5,000 coming from here. And what is the other chance? The other chance is that the R&D work is worthless. So R&D worthless, and there is a 40% chance that the R&D is worthless and we do not get anything from its sale. So it's $0. So now our decision tree is complete. So now it is very easy for us to calculate the expected value without the information. So we always work from right to left. So I shall just copy the decision tree into the next slide. And we will number all the chance points and the decision points. So it is A, B, C, and D. Now, first we will calculate the expected value at point A. Expected value is given by the formula sigma px, where P is the probability and X is the outcome. So EV at point A. So it's probability of 0.2 multiplied by outcome of 100,000 plus probability of 0.8 multiplied by outcome of 60,000. So that's what I've written here. So the expected value at A works out to $68,000. So we write $68,000 on top of point A. Next, we will calculate EV at point B. So it is probability of 0.6 multiplied by $5,000 plus probability of 0.4 multiplied by 0, giving an amount of $3,000. So the EV at point B, $3,000, we will write on top of point B. Now, what is the EV at point C? It is the probability of 0.7 multiplied by 68,000 plus 0.3 multiplied by 3,000. So that's what is written here, giving an amount of $48,500. So the EV at point C is written on top of point C. How does it decision point D? In case of decision point, we have to choose between the two alternatives. Should we develop the product or should we not develop the product? Now, if we develop the product, we get an average profit of $48,500 minus there is an expense of $40,000. So the net amount comes to $8,500. So since we get a net EV of $8,500, that is $48,500 minus $40,000 against 0, we will definitely develop the product. So the decision at point D is develop the product as expected value is $8,500. So we write $8,500 on top of decision point D, indicating that we have decided to develop the product. Now, what should we calculate? Now we should calculate the expected value with information. That is, after we get information from this agent 008, what will be the average profits? So to work out the EV with information, there is an easy method. This is a decision tree that we created for calculating the expected value without information. Now, for calculating the expected value with information, we will not take a decision initially. Why? We are waiting for the information from agent 008. Only after he gives the information, we will do the decision part.
So we will draw a dummy decision tree just for you to understand the logic of the calculations.
So what I want you to do is this part. Ignore this part, that is the decision part. I'll just erase the decision part. Draw the decision tree from point C onwards by ignoring the decision part. Why? Because we will first get the information and only then we will decide. So how will the decision tree appear? So I'm going to write the chance point. This chance point 1 is equivalent to this chance point C. Okay. Now look at the original decision tree. There is a 70% chance that we will be successful and there is further a 20% chance that we will get high profit. That uncertainty is already there in the market. It is just that agent 008 will give us this information beforehand. So that uncertainty is not going away. Now listen carefully. What is the probability that your product is successful and you get a high profit? You have to calculate the joint probability. What do you mean by joint probability? There are two events right now. The first event is the product is successful with a probability of 70%. And the next event is getting a high profit with a probability of 20%. So what is the joint probability, or what is the probability that both these events will take place? It is nothing but 0.7 into 0.2. To get the combined probability or to get the joint probability, you have to multiply the individual probabilities. So I'm just going to write here event and joint probability. So the first event and the joint probability is your product is successful and you get a high profit. That is this path. Okay. So what is the joint probability? It is 0.7 multiplied by 0.2, or it is 0.14.
So what does this mean? It means that there is a 14% chance that agent 008 will tell us that your product will be successful and you will get a high profit. And if he comes and tells us, then what will we do? We will definitely develop the product.
And what is the profit associated with this path?
Now, if we get information from agent 008 that our product will be successful and we will get high profit, then we will immediately decide to develop the product, in which case we will incur $40,000 as research and development. And finally, we will end up with a profit of $100,000. So this research and development expenditure will be incurred only after we get this information. What information? That our business will be successful and we will get a high profit. So what is the net profit that we are going to get? The net profit will be $100,000 minus $40,000, or it will be $60,000. Now, many students have a doubt and they ask that in EV without information, we consider $40,000. That is the expenditure incurred for R&D before these probabilities. But in the EV with information, what we are doing is we are considering the 40,000 expenditure after the probability. Why is that? The reason is simple. Just think for yourself. In the first case, that is EV without information, we are first incurring the R&D expenditure and only then the probability of a success or failure happens. But in the second case, we are waiting for the information from agent 008. And it is only when we get information that our product will be successful that we will invest in the R&D expenditure. That is why the R&D expenditure is coming after the probability in this case. Only after we get the information, we will incur. But in this case, we will incur first, and then there is a chance that we might have a successful or a failed product. Now, what is the next event? Focus on what I am circling. That is, we are having a successful product and we are getting a low profit. This path. Okay. So successful and low profits. Even if we are getting low profits, we are still getting a profit, right? Because 60,000 is the ultimate profit. Even if you reduce the R&D of $40,000, we get a net profit of $20,000. So even with this information, what is this information? That is successful product with low profits. We will still decide to develop the product. So in this case, what is the joint probability? It is 0.7 multiplied by 0.8. So the joint probability is 0.56. And what is the profit? Profit is 60,000 minus R&D expenditure of 40,000, giving an amount of $20,000. Now, what is the next event? The next event is if we fail. If we fail, whether we get $5,000 or whether we get $0, it doesn't make a difference, because ultimately we will be ending up with a loss, because 5,000 minus 40,000 R&D is negative 35,000. So if we know that the product will be a failure, then we will decide not to develop the product. So the last event is if the product fails. You don't need to demarcate between these two, because whatever be the case, we will decide not to develop the product because we will end up in a loss. Now, what is the probability of failure? The probability of failure is 30%. So I'm just writing here 30%. And what is the profit? If agent 008 comes and tells us that your product will ultimately fail, then what will we do? Will we spend on the development expenditure of 40,000? No, we will just discard that product. We will not even spend $1 on the R&D expenditure because we already know beforehand that the product will be a failure. So what is the profit that we are going to get here? $0. And why is the profit taken as 0? Because we will not be proceeding with the project. Now we will calculate the expected value with information. So the expected value for the circle 1. EV at chance point 1 is nothing but EV with information. So how do you calculate EV? We know it as sigma px. That is probability multiplied by outcome. So it is 0.14 multiplied by $60,000 plus 0.56 multiplied by $20,000 plus 0.3 multiplied by 0. So the EV with information amounts to $19,600, which means that if we get the information beforehand from agent 008, our average profits will be 19,600. When we did not have any information, what was our average profits? It was $8,500. So we are getting an increased profit, correct? So what is the value of information? So the value of information is EV with perfect information minus EV without information. And what do you mean by value of information? That is the maximum fees that we can pay to agent 008. So the amount works out to $19,600 minus $8,500. So the value of the information is $11,100. So that's the maximum amount that we can afford to pay to agent 008. Now, the decision tree that I have drawn here is only a dummy decision tree. That was drawn just for giving you clarity about the topic. This is not actually a decision tree because decision tree will always start with a square. That is a decision point. Here we have started with a chance point. So once you understand the logic of the answer, I don't want you to draw a decision tree. Don't bother to draw all these circles and the connectors. So the final answer that should appear in your answer sheet should appear like this. That is event and joint probability, and all the events and the joint probabilities should be written in a table format. And even the original decision tree, that is EV without information decision tree, can also be presented in a tabular format. How do you represent this decision tree in a tabular format? It is simple. We have to just calculate the joint probabilities. I will show you how. See this? EV without information, the decision tree has been shown as a tabular format. And what have I done here? There are basically 4 outcomes when we are developing the product. So all the 4 outcomes have been written in the form of a table. See the first part? That is, we are developing the product and we will have a successful product with high profits. Successful product with high profits. And what is the joint probability? It is 0.7 into 0.2, giving a joint probability of 0.14. And what is the profit? $100,000. So I've written the profit here, $100,000. Now going to the second part, that is, we are having a successful product with low profits. That is the second row. So the joint probability is 0.7 into 0.8, that is 0.56, and the profit is $60,000. Now going to the third path, that is, we are having a failed product and we are able to sell the R&D at $5,000. So failed and R&D sold. So what is the joint probability? It is 0.3 into 0.6 or 0.18, and the profit is $5,000. And the last path, we have a failed product and the R&D is worthless. We have a joint probability of 0.3 into 0.4, that is 0.12, and the profit is just 0. And how do we calculate the expected value? Sigma px. So it is probability multiplied by outcome. So 0.14 into 100 gives $14,000. 0.56 into 60,000 gives 33,600. 0.18 into 5,000 gives $900, and 0.12 into 0 gives $0. So the EV is 48,500 and we have an initial development cost of $40,000. We reduce it to get the final EV of $8,500. So we get the very same answer that we got in the decision tree. So I explained it with the decision tree because it will be very easy for you to grasp the concept. Any decision tree can be converted into a tabular format by calculating the joint probabilities. Value of perfect information. You have to calculate EV without information by drawing a decision tree. And then you have to calculate the EV with perfect information. And how do you calculate EV with perfect information? You modify the above decision tree by starting with the chance point. That is, you ignore the decision part because decision we will take only later, and calculate joint probabilities. And the initial R&D expenditure should always be reduced from the final profits returned at the end, because we will decide to invest in the R&D only after we get information from the agent, only if we know that the project will be successful. If we know beforehand that the project will be a failure, we will decide not to invest in the R&D expenditure. And finally, you calculate EV for the chance point, which is nothing but the EV with perfect information. And the value of perfect information is always found out by reducing the EV without information from the EV with perfect information. And an important note is any decision tree can be converted into a table format by calculating joint probabilities. I hope you have understood how to calculate the value of perfect information. Now, what is left is the value of imperfect information. We will be taking it up in the coming session. So thank you for watching and see you in the next video.